Thanks for joining us today for the May 9th edition of Market Matters. For those that I haven't met before in person, my name is Todd Jones. I'm the Chief Investment Officer for Gratus Capital. Thanks for joining us. So we're going to keep rolling here in the normal state of what we do things. As a quick agenda. We're going to touch on these items in slide format. So I hope you enjoy the new format where I'm trying to list out, give you guys an idea of what's in front of us and kind of where we're looking at opportunities. And then the special topic, because we have had some interest more recently. Certainly, I think it's no surprise now that gold is nearing an all-time high. Just kind of our thoughts on gold itself, portfolio application, and just some ideas that we've got from the investment committee. So let's get started. And we're going to first touch on the 2023 economic update and investment outlook. So, I've shown this slide pretty frequently, but I think it does bear mention that this is a broader picture of the overall health of the U.S. economy, broken out into two broad categories. The services sector, that's things like consultants, tax preparers, attorneys, things of that nature, broadly comprising the services sector that represents roughly, call it 75 to 80% of the total U.S. economic output. And the manufacturing sector, thinking car manufacturers, medical device companies, things of that nature, represented there in the manufacturer in that orange line. Just for orientation, that dashed line represents the 50 number. So anything below, reading below 50 indicates contraction in that segment of the economy. Any reading above 50 represents expansion. And so what you can see here is a pretty clear picture of what's been going on recently, where we've had, coming out of COVID, some pretty low levels of economic activity really ramping up through 21 as stimulus and reopening activities started to occur, with a peaking at the beginning of, call it last year or so, with a pretty consistent deceleration of economic activity, with the manufacturing sector now being in a bit of a contraction since the end of the year last year. And so what is the picture telling us now? Well, I think because the services sector represents such a dominant part of the U.S. economy, the expansion is certainly going to be captured, and that's generally showing up in what they call gross domestic product, or GDP. That's a broader measure of economic growth. Right now, GDP now estimates for Q2 coming out of the Atlanta Fed are running right around 2.7%. That can change quite a bit, but I think it just is emblematic of the fact that the U.S. economy is still humming right along, maybe a little bit slower than it was last year or year before, for that matter, but still in a decent expansion territory. So I guess what the other suggestion of this picture is that, yes, there are higher probabilities of recession on the horizon, but nothing imminent, according to this chart. The other picture we like to take a look at more recently has been what's going on with currencies, because that is having a big impact on asset price returns. This is just a picture of the dollar index, the DXY, and you can see it going back all the way to 2013. So a 10-year picture of the U.S. dollar. So if this line is rising, that means versus our trading partners, think Europe, Japan, China being the primary trading partners, then our dollar goes further, buying more goods and services from those areas. If this line is going down, however, that means that we're able to purchase less goods and services with our trading partners. And that's really, something to keep track of and keep an eye on, because there's been a lot of chatter within the investment community. And I know places like the Wall Street Journal and Bloomberg have wrote stories about, countries trying to diversify their foreign exchange reserves. And there's been some people calling for the demise of the U.S. dollar. And so I think that it really needs to be thought of, the dollar needs to be think of two different ways. One is that as far as trade settlement goes, the dollar comprises roughly 85–90% of all trade internationally is settled in U.S. dollars. A variety of reasons for that going back many years, but that's been pretty consistent over the years. What has changed a little bit, which is also, I think, leading us to some of the comments or thoughts around gold, is that the composition of those reserves, foreign exchange reserves that countries hold in their coffers, is starting to shift a little bit. And so, I think it is instructive that Chinese government has not purchased any U.S. Treasury bonds for the better part of, I think, about a year now. And what are they buying instead? Well, they're buying things like gold or other currencies to diversify their foreign exchange reserves. So all that to say, if the dollar goes down, that's, kind of indicating that there is less maybe need or confidence in the reserve currency of the world as it currently stands, and that we need to be mindful of that. Do we think there's going to be a dollar collapse anytime soon? No, that's definitely not what we're saying here. But if this U.S. dollar starts to decline versus trading partners, I think actually one of the actions we would take would be to add more to international stocks, because if the dollar is going down, then theoretically other currencies are going up just because they have to. That's the nature of how fiat and currency exchange works. Looking at the banking sector, I do think this is a good chart to revisit. I showed it on Market Matters, 2 Minutes with Todd, the podcast, a few weeks ago. But it just shows the number of bankruptcies over the years. And I do think it's worth revisiting to say that there have been a small number of bank failures more recently. JP Morgan's been active with buying companies like First Republic. But I think what this also maybe infers or suggests is that once bank failures start to occur, it's very rare is the case that it's isolated to just a handful. So yes, that maybe the Fed and Treasury have isolated or ring-fenced certain regional banks, but I don't think that what created the issues with those regional banks is a significant decline in their bond portfolios. And I think it's just too early to tell and say the all clear that all bank failures are behind us. So that could create some additional volatility further on in the year, but something that we have very little exposure across all of our accounts to any financial banking centers in our dividend strategy. In fact, the only bank we do own is JP Morgan, which the likely beneficiaries of this chart right here would be the largest banks. So the JP Morgans, the Wells Fargos, Bank of America, Citigroup, all in a position to be supported by the Federal Reserve and the U.S. Treasury. And I think, longer term, our banking sector is likely to evolve into something not too dissimilar to what the Canadian system is right now, where there's a small handful of very large banks that are treated more like utilities than actually economic drivers of growth or risk-taking for that matter. Touching back on this again, this is where is some stress likely to occur? Well, we've all been reading about, issues within the commercial real estate sector. Again, this is a slow-moving, ship. You can't really turn it very easily. And I think it's just important to mention that there has been a very significant re-rating within what they call cap rates or basically income that these properties kick off. And if the income yield of these properties is rising, that means that by extension, values have to fall. And so, we've been, monitoring the situation very closely because one of the largest underwriters of commercial real estate has been the regional bank system. So that is another potential area of concern. But again, right now we just have to keep an eye on how this evolves because, banks can extend or amend terms of loans they previously extended. And a lot of that's happening anecdotally with some of the positions that we have on the private side. So we just are very mindful of where this could lead. The public REIT sector, however, is a bit of a different animal because there is some real-time pricing discovery going on in the private and the public sector. On the REIT sector, VNQ is the major ETF there. The VNQ REIT was down roughly 30% last year. Not to say that that's what's going to happen within private real estate, but that has already been marked down. And over the last few weeks, what we have noticed is that real estate, even if the broader market is going down, has been very resilient, holding right around here around current levels. And in particular, the office REITs that we've been keeping an eye on, things like SL Green or Vornado, Boston Properties have all been very, very stable around current pricing levels because their prices are down 50, 60, 70% in some cases. So this is an area maybe of opportunity, because if it looks like commercial real estate is stabilizing, first within the public sector, then that's likely to extend to the private sector, not too much further down the road. And that would be probably a unique opportunity to pick up, investment property at much higher yields. And similar themes, and I don't know if I showed this on the last Market Matters or not, but I think there's still a pretty big expectations gap evolving within within the bond market in particular. We'll talk a little bit about stocks in more detail, but I think the big item that we still have on our radar that we're still keeping an eye on is this expectations difference between what the Fed is talking about when Chair Powell and comments that he mentioned last week was talking about how they will not necessarily be too quick to move with inflation still at 5%, a very tight labor market, meaning that unemployment rate still at 3.4%. That's nearing historical lows. And the employment cost index, meaning wages, are still rising at about the rate of inflation as well too. So until those things start to taper off, they in no way can think about easing financial conditions, meaning starting to cut interest rates. And that you'll see that refreshed chart that I like to show of how different those things can look. But we are, again, mindful of things that are getting pretty close to attractive levels or nearing them. REITs, I mentioned already. High yield bonds, again, have had quite a bit of spread widening over the last few weeks. So they're at about, I think, high yield bond spreads to treasuries are about 5.25% higher than treasuries. Our mark on the wall is, say, or the high water mark is right around between 7 and 8% for high yield bonds as a spread to treasury, for those to get really attractive. No real changes to our investment ratings. Still have a bit of a preference for mid-sized companies at the moment. And I think we talked about why last time, but valuations on mid-sized companies have not been this reasonable relative to the S&P for any year for the last 20, essentially. What that means is mid-cap stocks are trading at a bit of a discount to the S&P at the moment, so that makes it attractive. We still have this neutral, maybe positive bias to developed international markets, so thinking Europe. That's turned out to be a pretty useful way to play the China reopening, which is occurring right now. And that's been a good allocation to have this year. And on the bond side, we still continue to be very conservative, with roughly 40% of our portfolio in government or high grade investment grade bonds that are short duration. So I think 1 to 3 to 5 year duration. Certainly nothing like the index, which is 6.5 to 7 years in duration. And this is something that we certainly want to make sure we're covering the right way, because this is what you're seeing on the screen are two things. One is that yield spread that I mentioned. That can be a indicator of risk appetite or risk-taking ability. And the purple line there, it's a dual axis, so you got to be kind of careful reading this thing too carefully. This is a year-to-date picture. And this is also a year-to-date picture of the VIX, or the volatility index. So it's basically a risk-taking appetite within the equity market. So bond market proxy for risk in the purple line, and equity market proxy for risk in the orange line. And again, mind the expectations gap, both can't be right. So what's been going on recently is that you can see historically, and this would show if you were to stretch it back even longer, is that credit spreads on high yield bonds and the volatility index tend to rise and fall at the same time. Just, I think, intuitively makes sense, because equity and bond investors can think very similarly in risk off periods, because high yield bonds are actually pretty highly correlated to equities or stocks. But what you might notice more recently is that while spreads in bonds have risen, and this is as of the 5th of May, but high yield bond spreads are up here now, 5.25. The VIX index has stayed down here at this 17, 18 level. So while high yield bond spreads have risen, the VIX has remained relatively benign. And all that to say is that either high yield bond spreads would come down, or the VIX needs to go back up. And if I would say, to wager which way it would go, it would probably be with the VIX heading back up because, volatility in equities would make a lot of sense given there's still quite a bit of uncertainty on the horizon within the economic picture. So here's a snapshot of where we sat with Q1 earnings. So just to give you a sense, and as we've been talking about, Q1 is going to be a pretty important metric to judge maybe what the rest of the year will do. And the good news is that companies on average have been beating the expectations for earnings by a pretty decent amount. So what you see here is every S&P sector, what the expectation was in the gray bar of earnings growth. Or so just for reference, the industrials on March 31, we're supposed to see earnings growth of about 12.7%. What actually happened though is that the industrial sector saw earnings growth of 21.1%. So this is a big reason as to why industrials are one of the top 3 leading sectors this year. Interestingly, however, energy is not. Energy is actually lagging the S&P right now in price performance, even though earnings are beating by a pretty wide margin. But S&P wise, just to bring it back home, the S&P, at the beginning of March, or I'm sorry, end of March, analysts thought that the S&P earnings would drop by 6.7% on average. Today, and this is as of May 5th, they've actually only dropped 2.2%. So that difference really accounts for a big part of why the market has had a pretty good performance so far this year, led by a lot of companies within information technology and even consumer discretionary. Consumer discretionary is basically Amazon and a few other handful of companies. So Amazon on really good reported earnings, Apple, Microsoft had really good earnings reports. And so that's one reason why the market is where it is today. The unfortunate thing though is that we still have a couple of dynamics at play that make us a bit uncomfortable. One is this chart right here showing as a total number of the 3,000 companies in the Russell 3000. This is going all the way back to 1996. The number of zombie companies meaning companies that have debt service coverage below one times for the last 3 years. So basically, can the company meet their debt service without having to raise additional capital just through earnings? And the unfortunate reality is that now, pre-COVID, there was probably, 9% of companies in the Russell 3000 had less than one times interest coverage. Now we're up to 11, maybe 12, and this is of course heading into potentially a recession on the horizon. We don't have any certainty with that assessment quite yet, but that number is likely to get a bit worse, and that would just put upward pressure on the PE multiple, making the stocks more expensive. And that's not a great situation to be in because it just lends itself to a gap down that in price to readjust for earnings that aren't there. So that's one dynamic. The other dynamic that is at play right now, but actually I mentioned in the last 2 minutes, I couldn't get the slide in time for this broadcast, but is the fact that the market is very concentrated right now within the, where performance is coming from. So just to give you a sense, in the S&P 500, the top 10 companies, of course, those are, Apple, Amazon, Microsoft, Tesla, and a few others, account for, call it 95 to 96% of the S&P's returns so far this year. The other 490, however, are accounting for, 4%, a total of 4% of the return this year. So, just to maybe bring it home to a number you can relate to, if the S&P is up 10, the 490 companies account for 0.4% of that return. So not a super meaningful number because it just means that there's a lot of companies that are down for the year versus the handful or a few like Apple, Amazon that are up, pretty decently so far. And that concentration is generally corrects itself as it has in prior periods. Some bright spots I would mention, we have been a little negative on residential housing prices, just given the affordability ratios have been very difficult to compete with. But I think what the U.S. housing market is starting to reflect or show is that there's quite a bit of underlying demand still within U.S. housing. This is a chart from Apollo and the National Association of Realtors that basically shows that after a pretty steep increase in the number of bids per property sold, starting post COVID, right? Everyone was moving around and indulging on low interest rate mortgages to buy houses. There were at one point at the peak, December last year or of 2021, 5.5 bids per listing or per property sold in the U.S. And that declined pretty rapidly down to, I would say, a pretty average level of around 2 to 2.5. And now that's starting to reverse. And what's happened, of course, is interest rates have come down. But I think also people have realized that there's still a dearth of supply out there, which is supporting prices. And some people are just having to pay up a little bit. So this is still a very resilient part of the U.S. economy that has tentacles everywhere that can really be a meaningful driver of economic development going forward. This is just another chart on the residential market. You can see in the pricing, this is a 6-month rate of change in pricing. So annualized rate of change in pricing. So at one point, on a 6-month rate, there are some markets like Phoenix, which is always one of the hottest markets when property prices get hot, clipping along at a 40%, price rate of appreciation for a small time there. And that went all the way down to a -20 more recently. And those markets have been hit pretty hard by the increase in interest rates and fall back in the number of bidders coming into the market. What we can see more recently, though, is over the last 2 to 3 months, those prices have started to inflect back in an upward direction. So not to say that we will see these levels of 2020 and 2021 anytime soon, but generally a good thing to see that inflection because it means there's embedded demand or support for the asset class. Turning to bonds, just wanted to touch on this chart again because this is updated as of 4/30. I think the Fidelity updates this maybe once every 2 weeks or so. But what you can see here is, again, the big disconnect that's evolving between the Federal Reserve, which is these purple dots, the average of the purple dots of where they believe rates are going to be at the end of the year, which is, call it, 5 to 5.25, going down to they believe on average somewhere around 4 to 4.25, and then longer term down to that 2 to 3. But what the market is saying, and this is the implied Fed funds rate, the SOFR curve, is saying a completely different picture because they're singing a completely different tune because they think the market's thinking we're actually going to get cuts by the end of the year in the Fed funds rate, probably because of some sort of recession to somewhere in the neighborhood of 3.75 to 4, which is a big and different number than the 5 to 5.25 I was mentioning. And then out into 24, it's even probably more stark in that the average level of Fed funds and market participants are seeing is somewhere around 3% versus that 4 to 4.25. So again, they both can't be right, the Fed and the market, and that one must adjust. So the expectations are maybe a little off on one side or the other. And so I think because of that, we need to maintain a fairly conservative position in our bond portfolio and even in some other areas or asset classes, because that adjustment period can be really pretty messy. So just a takeaway before I get to the comments on gold here is, again, we still think that, the rally in 23 is definitely rooted in capital flows, although the fundamental picture is getting a little better, which is nice to have that as a support. We continue to see, or have a bias for U.S. large and mid-cap companies on the equity side. And that, certainly while it's not concentrated in technology, our portfolio is doing, just fine in the current environment. Alternative strategies over bonds still, while we have a nice short end of the bond curve paying us a good rate of return, think 1-year bond is about, over 5%. That's not going to last forever, and that's certainly we'll take it while we can. But we're going to hang out in this shorter term interest rate environment on the short end of the market, until we get some more clarity around longer term where the economy is going to land. And things like high yield, it's just not attractive to take that kind of risk quite yet, although we're getting there. And I think that it's important to note as well too for private investors or investors that have exposure to private assets. The pricing for certain types is now beginning to move around a little bit. So we have seen this not only in some of the portfolios we manage, but in other portfolios that we don't have exposure to. And that is likely to lead to some really attractive opportunities. We don't know exactly when, and none of us can really know when those exact times are going to be, but I think we're approaching a point for not in the not too distant future where some opportunities in real estate in particular, but also private equity, are going to show some really attractive returns, risk and return proposition. So let's move on to the topic, gold as a diversifier, because I do think this is an important topic to touch on, because the dynamics in gold, I think, are a little bit misunderstood. And I just want to make sure everyone understands, our thoughts on the matter, but also some of the broader context. So this is a chart going back to the early 70s of gold priced in US dollars. That's the purple line, and the S&P 500 index. I just wanted to reference a common waypoint, because if you were to use a percentage increase for both the S&P and gold since this time back in the 1970 is the exact start date, would you be surprised to know that actually the S&P and gold have had almost the exact same return back through this time frame. Now, obviously, the S&P has probably been a little more consistent. There's definitely been an upward bias over the years. Whereas with gold, you can see here, particularly after that big spike up into 1980, there were many years, call it 20 years actually, maybe more, where gold didn't previously eclipse its nearer term high. So, just a observation to make here, but I think that to categorize gold as an asset that doesn't have any return potential, I think is really missing the point here, because time matters, purchasing power, preservation matters, and I think gold would show you that there is an opportunity in there at during certain times. From a portfolio perspective, this is where I think we spend some time really understanding and trying to find those true diversifiers. Gold actually is one of those positions, as we've said over time, that does a good job of actually diversifying a portfolio. I would caveat that by saying that I don't think that gold should be owned, as a permanent position. So I know there's some that think, you should have gold as a permanent part of your portfolio. I'm not of that belief, but I do think that, there are regimes that you can own gold in and have a very successful outcome. We have owned gold previously, from 2011 to 2013 during the European financial crisis. We owned actually gold miners position to positive effect. But this chart right here, I think, does a great job of proving that there are some diversification benefits to gold. So this shows the correlation. So it basically means that a correlation of 1 means that, for every, if gold is moving up, then the other index is moving up along with it. And if gold is moving down, then the other index is moving down along with it. If it's a 0 correlation, that means that if gold is moving up, that doesn't necessarily mean that the other index is moving up. It could be moving down as well. And if it were negative, it would just be the inverse effect, right? So what this shows you is, if you just take one of these lines, gold versus the S&P at 0.09, that is a almost insignificant reading of correlation, meaning that any number that's not 0.7 or higher is just noise. So versus the S&P, gold has 0 correlation, is essentially what that tells you. And there's just a little bit of correlation between gold and the bond market. And this is going back to, I think it's 2002 as the start point here. So this is a 22-year correlation matrix. But I think it just does a good job of telling you why you might even want to consider gold as a position, because there are true diversification benefits. And as I mentioned on the previous slide, there are performance benefits that could be attached to that as well too. And just to wrap up our discussion here, there's often misconceptions, I think, but it's useful to list out, what are some of the pros and the cons. On the pro side, and I could put a number of slides together for each one of these bullets here, but I think just to keep it simple, this is good for now. We can follow up with any other follow-ups if you'd like later. But I think there is certainly, a historical argument can be made that it's a store of value. And the primary reason that gold is a good store of value is because there is limited supply. Unlike dollars or bonds that can be issued for a variety of purposes, gold is one of those things that you have to pull out of the ground, expend time, energy, and effort to get that supply. And because of that limited supply, there is an attached value to it. It can act as a hedge against currency debasement. So what you might notice is, during periods where the dollar is declining, and there's some great charts around this I could certainly share, but when the dollar is declining, gold is generally going up in value because it's holding its purchasing power relative to other items, is what that really means, versus maybe a stock or something where that stock could be going down based on financial conditions. So it can act as a hedge against the currency debasement. So you see gold pop up in portfolios in a lot of countries where there's high inflation and a lot of currency devaluation going on. So think countries like Iran or Turkey or Argentina, and historically India have all had higher levels of inflation and high levels of gold accumulation. It can act as a flight to safety asset during volatile market conditions. I think that's exactly what you're seeing right now with regional banks or just the banking system in general experiencing stress. Generally, gold finds it because it's gold exists outside the financial system. Therefore, assets that are preservation of value can act as that flight to safety during those conditions, because that's one of those things people can fall back on and feel comfortable knowing that gold isn't going to necessarily be printed. More of it can be printed. And I think one of the other reasons right now to consider gold, or that one would consider it, would be that I mentioned foreign currency reserves of central banks. Well, if they're not buying dollars, they have to buy something with the currency reserves they're accumulating. And a number of central banks, notably China right now, are accumulating gold instead of dollars or treasury bonds in their foreign coffers. Because, again, they think that, maybe our budget deficit and debt are going to be burdensome at some point down the road, and that having a store of value would be more valuable than dollar bills that are losing purchasing power as years go along to inflation. On the contrary side, what would be reasons that you wouldn't necessarily want to buy gold, or why wouldn't it be attractive right now? I think as this chart shows you right here, there can be very long periods of low to negative returns in gold that you have to get comfortable with if you're going to own it long term. This is why I think that there is an ability to purchase it during certain cycles as opposed to owning it as a dedicated position. So and when do those cycles tend to work, or what are those cycles in our opinion? It's when there's periods of financial stress that show up that impact the banking system. So early 80s, of course, was a period when that might have been attractive to accumulate and then decumulate. Financial crisis, you can see a big run up in gold as stress started building. And then, stress started building in the financial system a little bit before COVID, but actually certainly in and through COVID is when that all started to become very evident. And I think the big reason that you wouldn't want to own it would be those long periods of unattractive returns, because if other things like stocks are going up, it can be very difficult to say, well, why wouldn't I just own stocks for the long run versus gold? And that's certainly an argument that can be made. But I think diversification would be the main antidote to that argument. Historical precedent of government price manipulation for gold, or even things like CPI. There were long periods in our U.S. history and also internationally where governments have manipulated or tried to peg the price of gold to certain currencies to try to keep inflation under control. That ultimately gets unwound, of course, as market forces take over, but there can be very long periods where gold prices can be manipulated by governments or even banned outright, like it was to own gold bullion as a U.S. citizen during the Great Depression. And then the other reason, if you're going to buy physical gold, the ownership process can be really a little complicated. So not only do you have to find a place to store it that's safe, but also you have security measures that need to be taken into place. And there's also the buying and selling process. If you're going to be going through a gold dealer, either a coin dealer or a bullion bank or something like that, those can be pretty expensive mediums to transfer through or transact through, because generally on either side, the dealer is taking a fairly substantial margin or discount in what they're paying you if you decide to go ahead and sell. So I hope that gives you a little bit of context, just to reiterate some of our thoughts here. Certainly something that we've owned on and off over the years. We could be approaching one of those periods where, financial stress in the financial system or banking system creates an opportunity to own it for a period of time, but it's unlikely something we would own for longer than a few years, for that matter, because of that tendency that I shared earlier of gold to go through periods of relative strength, but then very long periods of low performance. So that takes us about to our time today. Thanks for tuning in. I know this was a topic everyone wanted to hear a little bit more about, so glad we could cover that today. If you have any follow-up questions, feel free to throw them my way, or talk to your advisor, and we'll certainly get back to you with any comments. Thanks everyone for joining us. We look forward to speaking to you again sometime soon.